Hi folks, my name's David Howes and welcome to video number 6, Property Analyzer. I'm going to show you in the next few minutes how we analyze immediate equity, added value, after-tax cash flow, and capital growth in just a few minutes. Again, this is video number 6 in the series, and of course feel free to watch these videos in any order you like, whatever's most interesting or convenient to you. If you watch them from 1 through to 8, they'll probably make the most sense. Okay, so we're moving on from finding real estate, as we were looking at in the previous 3 videos, and now we're moving on to analysing opportunities, because of course, the second key to leveraging our time after locating a property is the ability to analyse numbers before we visit the property. So our rule at Real Estate Investor is to fall in love with the numbers and then learn to like the property. And again, it's all about comparing the differences between deals in terms of their total return. So what do we mean by that? Well, you need to be able to calculate, compare immediate equity, added value, after-tax cash flow, and capital growth easily, and so that you can take both a short-term and a long-term view. Now we analyse and produce a detailed summary of all of these factors with Property Analyzer in less than 3 minutes. Okay, so we're now looking at Property Analyzer. What we want to do here, folks, is produce a detailed report over the next 10 years of all of the property information from purchase price through to returns, through to capital growth and things like that. So here's how we do it. We jump into the property financial data area, and you'll see here I've already set up a number of details around a sample property. This property is based on a pair of duplexes that an investor purchased in New South Wales and Sydney about a year ago now. So you can see here we've set some details up around the property's mortgage structure. A year ago the annual interest rate was 9.25%, reasonably high of course. We've got some information down here, property expenses, rates, insurance, stuff like that set up. We've put some information in here for agents commission, some details about the consumer price index and the forecast CPI over the next 10 years, the average capital growth rate over the next 10 years, some fees around loan costs. Of course, we've selected our annual income bracket so we can estimate taxation benefits. We've got some details in here on the property's expected rent, so $260 a week each, or $520 for the pair. We've got some details down here around the purchase price, $520,000, the market value at purchase, which was $600,000, so the investor got it at a 13% discount below market. Some details around stamp duty, and pretty much we're set to go, other than some details around age of the property and depreciation. So let's go to the depreciation estimator. And we can see in here we can select by dwelling type, whether that's residential, commercial, office, manufacturing, that kind of stuff. We can select the property type based on that. Nearest capital city, in this case it's Sydney. Quality of construction, medium. We've got the building's square area, so 220 square meters. The contract was exchanged mid 2008. And in this case, the property was originally constructed in 1960, so it was, almost 50 years old. We can see as a result of that, our depreciation over the first 10 years is relatively minimal, because most of the property's building and fit-out costs have been written off already. So this depreciation estimator is put together in conjunction with BMT and Associates, and as a result of that, we've got a fantastic accuracy in terms of you being able to appreciate the impact of depreciation on a potential investment property, again, before you've spent any money, before you've got any reports done, just simply by getting the age of the building and the floor area of the property and putting that information into Property Analyzer. So let's go back to the interest only report and have a look at the information. We can see here that we paid $520 for the property. We can see here purchase price $600, and over of course 10 years. Our equity increases dramatically as our property doubles in value over 10 years. We're estimating we'll have about $540,000 worth of equity over that point in time. Unfortunately, because of the when we purchased this property, when we take into account the rental income, when we take into account property expenses, we can see that on a yield basis we've got about a 4.9% yield. You can see as a result of that, $28,000, $27,000 a year in rent. By the time we take out mortgage interest payments, property expenses, that we actually have a negative cash flow situation in the first year of almost $28,000. We can see that even on a weekly basis that's equivalent to about $537 a week, and we can see here as a result, even once we apply depreciation, which of course is minimal, and create total deductions, that although we've got a trading loss, if you like, of $29,000, our tax refund is limited to $11,000, giving us a situation where after tax we're losing $16,291 a year, or $313 a week. So that might sound a bit overwhelming, but I guess I'm trying to simplify the picture here. And the long and the short of it, with this property, even though we plan to make a $500,000 capital gain, we're talking about probably been out of pocket about $150,000 over the first 10 years in negative cash flow, and not a great position from a funding point of view and in terms of limiting your ability to buy other real estate. So how do we fix that? Well, there's three factors that really drive real estate returns with real estate investment. They are the interest rates, of course, rental income, and the age of the property. So let's go back to the financial data on this property. Let's say we made some improvements to the property. We increased the rent on this particular property by making some improvements to, $310 for each duplex, or $620 for the pair. I'm going to go and change that rent to $620. Let's go back to the interest only report, and we can see that after tax now, our position has improved from minus $16,000 a year to minus $13,500 a year. Still not that exciting. So let's have a look at the impact of the age of the property. Remember, this example we said was constructed in 1960. When I spoke to this investor and said, were there any other pairs of duplexes around at that time that were, more recently constructed? And he said, yeah, of course. There was actually another pair I was looking at, similar price, constructed in 2006. So let's change the construction date there and watch what happens to the depreciation. And you can see just like that, we've gone from $400 in the first year fading away to $11,500 in depreciation. And so how does that affect the bottom line? Well, let's go back to the interest only report, and we can see down here, as a result of greater deductions, as a result of a greater loss on paper, our tax refunds now increased from $11,000 to $14,000, and our after-tax cash flow has now improved to minus $9,000. So still obviously negative cash flow, but a better picture. Let's have a look at the final factor that really drives real estate returns, and that's the interest rate. So let's have a look at what does a 7% interest rate do to this property versus 9.25%. Interest only report. You can see we're almost back to break even. We're now negative $1,900 a year. If you remember from when we originally started at minus $16,000. Let's go back and say, okay, what does 6% do? Make that change. Interest only report. You can see now we're into positive cash flow by $1,280 a year. And again, if we take a 10-year view, we're now probably making about $20,000 in positive cash flow instead of losing $150 just from playing with those factors: rental return, age of the property, and interest rates. Let's have a look at what 5% interest does. You can see there, no surprises there, $4,500 a year in positive cash flow just based on those factors and those variables. So when it comes to analyzing the numbers, what you need to do, of course, when you've found a deal, and with Investor Search you can find hundreds of deals really easily, is call your agent, get the age of the property or the age of the building, get the floor area, and then you can do all of your analysis and check all the numbers out before you leave your desk, before you leave home, before you leave the office. So with Property Analyzer, I guess the key thing is it's simple to use, it's accurate, it identifies tax refunds, pre-tax and after-tax cash flow, it helps you project growth in property equity, yields, and the depreciation and mortgage calculators are second to none. And I guess most importantly, it takes the cost and the emotion out of decision making and makes sure you're well placed when you start the negotiation process to know what the numbers need to be for the deal to make sense.